How's it going out there? I'm Mike, and I have to say, it's getting harder and harder for me as of late to open positions in new companies that are on my watch list. It just seems like everything is running up to record highs as of late, especially the companies that I tend to be interested in, the really high growth, disruptive type companies. And you look at the S&P 500's returns last year or any other index, it really doesn't tell the story of what actually happened last year. There's a huge discrepancy between these really beaten down retailers, experiential travel stocks due to the pandemic, while the stay-at-home plays, clean energy, EVs, genomics, and other disruptive technology companies just literally shot to the moon. So really interesting year from that perspective. You just know it's not a normal year when you have two companies in your portfolio that off the March lows go up on a run over 1,000% in 1 year. And that's what happened to me. And I actually didn't hold any shares of Tesla at the beginning of the year. Those two companies for me were Jumia Technologies, the Africa e-commerce play, and Invitae, the DNA analysis testing company. So don't get me wrong, I'm still heavily invested in high growth disruptive companies, but heading into 2021, I actually built up close to about a 20% cash position. And I typically never go more than 20% cash, as I know it pays to be invested in the long term. But I wanted some cash available, some dry powder in case there is a 10% correction or a larger pullback, so that I can add to my highest conviction stocks or take new positions in some of the companies that have been sitting in my watch list. And I also actually started to look at trying to find a little more value to add to my portfolio. And I did that with the two companies, I think, that I'm going to talk to you about today. I added one of those companies, which is Corsair, which is gaming or esports hardware play. So think high performance PCs, keyboards, mice, headsets. And then the other company is Dropbox. So the cloud storage, file sharing company. They also offer a lot of collaborative office tools, e-signing, software as a service play. So if you like this kind of content, please consider subscribing to my channel and liking this video. So I'm going to start with talking about Corsair. So as I mentioned, they're more of a hardware play on esports or gaming, and also for content creation for YouTubers as well. So they create high performance PCs, keyboards, mice, headsets, and they've actually been huge beneficiaries at the stay-at-home trend due to the pandemic. So they've actually seen incredible growth this year, but they've actually been a pretty rock solid company for years. But they actually only came public this past fall, but they've actually been around for over 20 years. Looking quickly here at Corsair's stock chart, they trade under the ticker CRSR. They're currently trading at around $38 a share. They're a reasonably small company. Their market cap's $3.5 billion, and they trade quite cheap. So this company has had huge revenue this year, but their forward PE is still under 30. So you can make the argument that a hardware play is going to trade for a lower valuation, but it's still a fairly attractive valuation. Just looking here at their revenue growth, they actually just increased their guidance for the full year 2020, which they're going to report in February, to 52% year over year from 2019. So they're seeing massive growth. As I said, they're definitely beneficiaries of the pandemic as far as people staying at home and looking to upgrade their systems. But you look back, even in 2017, they saw 44% growth. So their growth does tend to be a little bit lumpy from what I'm seeing, at least the 5 years that I have access to. They did have, but all 5 years, they're seeing at least double digits growth. So pretty good stuff. That works out to an average growth rate of 27.8% over 5 years. So just looking here at a basic projection I have for the next 5 years for Corsair, I've assumed a 27.8% revenue growth on average for the next 5 years. And I just based that off the previous 5. So I've actually decreased it from the now 52% growth they're seeing in expected to see here in 2020. And then I also assume that they've actually continued to increase their net profit margin. So I've added about a 25% increase from 6.63% up to 8.29%. And I've also seen, I mean, with any of these projections, you're making a lot of assumptions, and that's part of the risk of this kind of analysis. But I assumed also that they're trading at a similar valuation. And that is a bit of a risk to this company, as they could, you could see them having a little bit lower multiple as a hardware play as well. But I think 32 is pretty good for a trailing PE if they're seeing this type of growth rate of in the high 20s. So if we project that out, we could see a share price of about 91.87 per share. That would be a total return of about 139.8% and an annual return of 19.12%. So not bad for a fairly, I think, low risk play given, its current valuation and in the market we find ourselves in. All right, now on to Dropbox. So many of you probably have had access to their free file sharing cloud storage at least. And that's what they're originally known for in 2007. But they've actually expanded to a suite of office collaboration tools. And they're going to soon be releasing their Dropbox Spaces 2.0, which offers, like I said, collaboration tools, task management, meeting organization, and that easily integrate a bunch of third-party applications as well. So basically any app that you could imagine. And they also acquired, I think back in 2019, HelloSign, which is basically an e-signature company. And they're actually have just launched a retooled version of that software product. So Dropbox has over 600 million registered users. And the big piece here is they actually have 15.25 million paid subscribers. So subscribers are like gold, right? Because once they're in that ecosystem and they're paying, it's more easily to retain them. And that number is also still growing. Dropbox is trading at the time of taping, at least about $22.50 a share, and it has a market cap of $9.3 billion. It's up over the last year about 21.9%, but it's actually still off the highs from its IPO back in 2018, where it got up to, I believe, over $40 per share. And the thing about Dropbox, they're actually profitable. So they're actually doing really well. They got a pristine balance sheet, and they have a forward PE of just 27.7, despite being a software as a service play. I think pretty incredible stuff given their double digits growth rate. So looking over the last 5 years, Dropbox's revenue have actually grown 207% at an average rate of about 20%. They're down slightly this year. It's looking to be about a 14% growth rate. So that's definitely something to watch in the future. We want to see that growth rate accelerating. But they also have reoccurring revenue of, just looking at their Q3 here, they have recurring revenue of 1.98 billion, and that's an increase of 12% year over year on the subscriber front. So that's great. And their paid subscribers are now at, as I mentioned, 15.25 million compared to just 14 million the same period last year. So the average revenue per paying user is actually also increased up to $128 per subscriber from $123 the same period last year. And really important here, guys, is they're sitting on $1.226 billion cash. So that is huge. We're talking about a $9 billion company, and they have over $1.2 billion cash. So they're really in great shape. Just looking at my 5-year projections for Dropbox, Dropbox is estimating that their net income for 2020 is going to be $82,724,000, around there. And they would have a net profit margin of about 4.46%. And so what I've done is I've actually used for my 5-year projection a 20% compound annual growth rate, as that's what they had the previous 5 years. And I'm actually confident that they can reach those levels for the next 5 years. It is a very competitive space in the cloud collaborative software file sharing space with Microsoft and others. But I think the areas is going to continue to grow. And speaking of that competitive space, there's actually a bunch of acquisition rumors floating around that Dropbox might be an acquisition target. So not necessarily a reason for me personally to buy Dropbox, but interesting nonetheless, as I think they would actually sell for a premium from today's share price. So something to keep an eye on. So I assumed a similar valuation as far as PE in 2025 as it has today. These software as a service companies often trade at a higher PE premium. And with this kind of growth rates, their forward PE at these numbers would still be quite reasonable. So, and I've also assumed that they continue to make improvements to their bottom line as they become more efficient, as they add more subscribers and can charge more per subscriber and implement a bunch of these new products that they're rolling out currently as well. So I've upped it from 4.46 to 8%. And you can see that gives you in 2025, that could give you a share price of $65 per share, which would be about 189% return over those 5 years, which you're looking at that on an annual basis, that would be close to a 24% return year over year. So definitely keeping a close eye on Dropbox. I probably keep a closer eye on these value plays than I would my more pie in the sky, big vision growth stocks. Basically because often there can be a reason that a company trades cheap. So I just want to watch it very carefully. If revenues were, and given the competitive environment, if revenues were to drop into the single digits, I might seriously consider exiting my position. But I'm confident that we could see growth rates moving forward of close to 20%. Both Corsair and Dropbox are not my typical style of investment, but I think they both offer a really good value hedge against a really high-flying growth stocks out there and in my portfolio. So, something to consider for your own portfolio and how it's structured, that there's diversification amongst sectors, but also against different types of investing styles as well. So anyways, I hope you enjoyed the video. Thanks for watching. Remember, always do your own research and due diligence before making any investment decisions. Happy investing.